Hello students, welcome to Accounting 1303, Introduction to Accounting 1. My name is Mrs. Mercado and I'm going to be covering or highlighting some of the important information from Chapter 6, which deals with financial statements and the closing process. And we are using the textbook College Accounting 23rd edition. Okay, so it's very important that before you start working on any of the Chapter 6 assignments that you read the chapter in its entirety before you attempt anything. Okay, it's very important that you read the concepts, that you read the information provided so it can make sense when you're actually applying that towards the assignments or the problems. Okay, so that's just a general overview. Please make sure that you do read. I have some students that are communicating with me that they're lost, but when I have a conversation with them, I get the perception that they're not reading the content because the questions that they're asking are clearly outlined in the chapter. Okay, so it is very important that you read before you attempt your assignments. Okay, so I'm going to start off just with a general overview of the basics of accounting. This information we should already be very familiar with because we have been covering it since Chapter 1. Okay, so it's very important that we do know the difference or understand what an asset, a liability, and owner's equity is. This is very important because depending on the type of accounts that they are, is the accounts that are going to be utilized to be able to prepare our financial statements. Okay, so this is just a general overview. So the financial position of a company is basically measured by the items which include the assets, which is anything that you own, liabilities is anything that you owe, any debt that you have, or owner's equity, which is basically the difference between your assets and your liabilities. Okay, so basically assets are the company's resources. These are the things that the company purchases that they own. Some of the most common examples of cash include some of the examples of assets include cash, accounts receivable, inventory, prepaid insurance, or any other prepaid. It could be prepaid insurance, prepaid rent, prepaid marketing, anything that's a prepaid. Investments, land, buildings, equipment, and goodwill. Now, liabilities are obligations. This is the things that you owe. These are your debt. Okay? Some examples of liabilities include notes or loans payable, accounts payable, salaries and wages payable, interest payable, and income tax payable. Anything that the company has a liability or the responsibility to pay for is a liability. Okay? And owner's equity or stockholders' equity is basically the amount that is left over after the liabilities are deducted from the assets. So it's the difference between the liabilities and the assets. Okay? So assets minus liabilities will give you your owner's or stockholders' equity. Okay? So your owner's or stockholders' equity basically reports the amount invested into the company by the owners plus any cumulative net income generated by the company that has not been withdrawn or distributed to the owners via dividend payouts. Okay, so this is just a general overview of what an asset, a liability, and owner's equity is. Now, this particular chapter is very heavy on the closing process and preparing your financial statements. Okay, you will have several problems on your test that deals with preparing financial statements. Okay. You do need to know how to prepare your income statement, your statement of owner's equity, and your balance sheet. Okay, that will be on your test. So that's the problem that I'm going to be covering. It's one problem that I'm going to be covering in this particular lecture because I do want you to understand how to prepare your financial statements. It is very important. Okay, so we have three main financial statements that are covered in this particular textbook that we're going to be going over. Okay, so we have the balance sheet. Okay, the balance sheet is also known as the statement of financial position, and it basically reflects the accounting equation. So what the balance sheet basically portrays or reports are a company's assets, liabilities, and owner's equity. Okay. And it reports this information at a specific point in time. Okay? Just like the accounting equation, it basically shows that a company's amount of assets equal the amount of liabilities plus owner's equity. So what the balance sheet basically does, it ensures that our accounting equation is in balance. Our assets equals our liabilities and owner's equity. Okay? So that is what the balance sheet reflects or reports. Now, the income statement is a financial statement that reports the company's revenues and expenses and the resulting net income or net loss. Now, net income occurs if your revenues are greater than your expenses. A net loss occurs if your expenses are greater than your revenues. Okay? While the balance sheet is concerned with one point in time, the income statement covers a time interval or period. Okay? The income statement will explain part of the change in the owner's or stockholder's equity during the time interval between the two balance sheets. Okay? And then we have our statement of owner's equity. The statement of owner's equity basically reports the change in the equity section of the balance sheet during an accounting period. So why did our equity increase or decrease? Okay? So it reports the events that increase or decrease our stockholders' equity over the course of the accounting period. Okay? So the report basically has a specific format, and it includes your beginning equity balance. Now remember, if it's a brand new business, your beginning equity balance will be 0. Okay? If it's a business that has been in operations for a couple of months or years, you will have a beginning equity balance from the prior period. Okay? But just remember, if the problem states that you are opening a brand new business this month, then your beginning equity balance will be 0. Okay? And after that, you're going to add your net income and any owner's contributions, if any, and you're going to deduct your net loss or your owner's withdrawals to be able to obtain the ending equity balance. Okay? So this is just a high-level overview of the financial statements. Okay? Make sure that we do read the chapter. The chapter includes great illustrations of each of the financial statements. That way you can follow along and try to decipher, what goes into each of the financial statements. Okay? In addition to the financial statements, this particular chapter is the last chapter of the accounting cycle block of chapters. Okay? So in this particular chapter, we are going to be learning about the closing process. Okay? So once we are at the end of the accounting cycle, we must close all of our temporary accounts. Okay? Every end of year or every fiscal year, we have to zero out or close out all of our temporary accounts. Okay? And only leave the balance of our permanent accounts. And temporary and permanent accounts are explained in your textbook. Okay? So your temporary accounts are any of the accounts that we want to start fresh every year because we want to accumulate new information. Okay? And this will include your assets. This is going to include your revenues, your expenses, and any withdrawals. Okay? So every year we want to make sure that we track this information brand new. Okay? So any expense account, revenue account, or withdrawal account that we have, drawing account that we have, we need to make sure that at the end of the year we zero them out. That way the following year we start off with a 0 balance and we can begin accumulating new information. Okay? Now any of the other accounts, which are basically your assets, your liabilities, and your stock, for example, those accounts we never zero out. We have a continuous recurring balance. Okay? We always want to make sure that we know how much cash we have. We're never going to zero out our cash because that account is an asset. It's something that we own until you basically close down your business, or shut down your business or whatever the case might be. You're going to close out those accounts. But if it's just a matter of for accounting purposes, then at the end of the year, the only accounts that we will be closing will be our temporary accounts. Okay? So the closing process entails closing out all of your temporary accounts. Okay? Now, there's a sequence of 4 steps that must be completed in the closing process. Okay? The first step, we're going to close our revenue accounts to income summary. Okay? Income summary is a brand new account, and it's only utilized during the closing process. Okay? So income summary throughout the whole year has a 0 balance. At the end of the year, when we're doing our closing process, we have transactions post to it, but then we zero it out that same day. So it's just basically a temporary account that is utilized for closing purposes. Okay? So the first step is we're going to close any revenue accounts that we have to income summary. Okay? So revenues have a normal balance of a credit. So in order for us to be able to close out our revenue accounts, we need to debit them, okay? So we're going to debit our revenue accounts to zero them out, and then we're going to credit income summary. So entry number 1, you debit your revenue accounts, you credit income summary. Step number 2, you're going to close your expense accounts to income summary. Expense accounts have a normal balance of a debit. To be able to zero them out, you would have to credit them, okay? So in this particular case, income summary is going to be debited for the amount of your total expenses, and then each individual expense account is going to be credited. That way they are zeroed out, okay? At this point, you have a balance in income summary for your revenues, and you have a balance for your expenses that have been put into income summary, okay? Step number 3, you're going to close income summary to the owner's capital account, okay? So you're going to calculate the balance in your income summary account, which basically represents either your net income or your net loss, okay? If net income has been earned, then income summary is going to be debited to create a zero balance, and the owner's capital account is going to be credited. If you have a net loss, then the owner's capital account is going to be debited, and income summary is going to be credited to be able to zero it out, okay? And then there's a figure in your textbook, figure 6.6, that basically shows examples of the closing process for both net income and net loss, okay? The last and final step in the closing process is to close your drawing accounts to the owner's capital account, okay? So drawing is basically any withdrawals that the owners of the organization or the business do. So drawing has a normal balance of a debit because it reduces the owner's equity. Therefore, if you want to zero it out, you're going to go ahead and credit it. The owner's capital account is debited, okay? So after you complete all of these 4 steps, all of the temporary accounts, which are your and I keep insisting with assets. All of the temporary accounts, which are your expenses, your revenues, and your drawings, those are the 3 things. Revenues, expenses, and drawings will be zero, okay? The earnings and withdrawals for the period will be transferred to the owner's capital account, okay? So what the closing process does, it closes out your temporary accounts, which are your revenues, your expenses, and your drawing, and it updates your owner's capital account with the updated balance, okay? So that is the closing process. It's just a 4-step approach. Make sure that you do follow the steps in that specific order. First, you close out your revenues. Second, you close out your expenses. Third, you close out your income summary to owner's capital. 4, you close your drawing to your owner's capital account. Okay? So those are the specific steps. Now, what I'm going to do is I am going to cover in this particular presentation, the whole objective of the presentation is to demonstrate how to complete financial statements, okay? You're going to have financial statements on your test. They are very important, okay? So, the problem that I am going to be covering in this particular lecture is problem 678. This is from your end of chapter problems for chapter 6, okay? And what we're going to be doing is we're going to be preparing our financial statements, okay? So let's look at the assignment instructions, okay? So it says, refer to the following worksheet for Megafins repairs. No additional investments were made by the owner during the month, okay? Now, they've done all of the work for us. They have provided us with a completed worksheet, okay? So we have our trial balance, our adjusted trial balance, and then they've transferred that information to either the income statement or the balance sheet columns, okay? So this makes it very easy for us to prepare our financial statements, okay? Any information in the income statement columns will basically go in your income statement. Any information in the balance sheet columns will go in your balance sheet, okay? And then we've calculated our net income for the period. We are required to prepare an income statement, statement of owner's equity, and a balance sheet. Now, it is important that while we're solving this problem, you do have the worksheet handy. Either you can take a screenshot of the worksheet from here, or if you prefer, you can just go to your electronic book and look up at the end of the chapter problem 6, 7, 8. Print it out and have it available. That way you can follow along. Okay. We do need this information to be able to prepare our financial statements. Okay. So I'm going to start off with the income statement. Okay. We're going to start off with the name of the company. The name is called Mega Fence Repairs. We are preparing the income statement, and we are preparing it for the month ended January the 31st. That is the information being provided here. Okay. Month ended January the 31st. Okay. So on the income statement, there's two things that we report. We report our revenues and we report our expenses. Okay. Revenues and expenses. If your revenues are greater than your expenses, then you have net income. If your expenses are greater than your revenues, then you have a loss. So, where am I going to obtain the information to put in here? Well, we're going to go back into the worksheet, and I said that there's two things that go into your income statement. Your revenues, which we have one, called repair fees for $4,700, and then we have all of our expenses. So what I'm basically going to do is I'm going to copy this information over to my income statement. I'm going to bring in my revenue account first, and then I'm going to bring in all of my expenses. So what I have done is on my end, I've printed out a copy of this worksheet. That way I don't have to be flipping back and forth because, it can get a little bit confusing. But I do have a printout of this worksheet. So I'm going to just be working off of that. So make sure that you do have this information handy. Okay. Just remember that I am pulling that information from the income statement columns of your worksheet. And I am first going to bring in my revenue. And then I'm going to bring in all of my expenses. Okay. So let's get started. So we're going to start off with our revenues. Okay. Let me see if I can type. Okay. Revenues. Okay. So we're going to start off with our revenues, and I had one revenue account called repair fees, okay? Because I only have one account, I'm going to bring it over to the second column, okay? If I had multiple revenue accounts, then I would include them in the first column, add them, and then bring the total to the second column. But I only have one revenue account. If you only have one, then just take it to the second column, okay? So we start off with our revenues. And then I'm going to bring in all of my expenses, okay? Remember, my expenses are coming from here. This is your revenue, $4,700. And then these are all my expenses, okay? Let me highlight this right here. So I'm going to bring in all of these to my income statement. Okay, so I'm just going to copy and paste starting from wages expense all the way down to miscellaneous expense. Okay, so that's all I'm doing. I'm just listing them and bringing them over. Okay, wages expense, and my wages was $21.50. I have advertising expense, and my advertising is $200. Then I have rent expense, okay, and it's $640, okay. Then I have supplies expense, and my supplies expense is $300, okay. Then I have a phone expense, okay. So this is where the company spends its money on its expenses, okay? This is what it needs to operate. We have insurance expense of $230. We have gas and oil expense, okay, of $200. Okay. And we have depreciation expense, expense for the delivery equipment of $55. Okay. And last but not least, we have our miscellaneous expense of $37. So what I'm going to do here is I'm going to add them all up. Okay. And I'm going to add them up, and I'm going to get my total expenses. Okay. So since I am using Excel, I'm just going to go ahead and put a formula here so I can add up all of my expenses. And that gives me $3,862. Okay. So in revenues, I made $4,700. Okay. My total expenses, this is how much money you spend in the operations of your business. You spend $3,862. Because my revenues are greater than my expenses, so if your revenues are greater than expenses, then you're going to have a net income. If your expenses are greater than your revenues, then you're going to have a net loss. Okay. In this case, my revenues are greater than my expenses, so I'm going to have net income. Okay. So I'm going to have net income, and what I'm going to do is I'm going to get my revenues minus my expenses. Okay. So your net income is revenues minus your expenses. Okay. Let me save this. So that is my net income, $838. Now it's very important that we calculate our net income correctly, because this information is going to be needed to prepare our statement of owner's equity. If you calculate this incorrect, then your statement of owner's equity will also be incorrect. Okay? So it's very important that you do your math correctly and that you bring in all of the accounts. So when you're done with your income statement, you should have used all of the information in your income statement columns. You should have used your revenue account and your expense account. Okay? All of this should have been utilized. Okay? So we are done. We are done with our income statement. Okay? We have calculated $838. Now, we're going to move on and we're going to calculate our statement of owner's equity. Okay? So, for our statement of owner's equity, we're going to begin with our beginning capital. Okay? So, we're going to have Don Megafin. Okay? Capital. January 1st. So let's go and let's look at our balance sheet here. Okay, so we have this capital account and it has an $8,000 balance. Okay, this is where I'm picking up the amount from. Okay, so I'm going to start off with my capital balance, which is $8,000. Okay, so I'm going to take that over. Let me close this. Okay, so I'm going to take that over to my owner's equity amount here, and I'm going to put in my $8,000. Okay. The next thing I'm going to bring in is I'm going to bring either my net income or my net loss that I calculated on my income statement. In this case, we had net income for January. Okay, so the amount that I'm going to bring in here is this amount. Okay, the net income that we calculated from your income statement. Okay, so this amount here is going to flow into your statement of owner's equity. Okay, so you're going to take that dollar amount and we're going to put it over here, $838. Okay, then I am going to deduct any withdrawals that I had. Okay, this is any money that any of the business owners pulled out from the business. So I'm going to go back to my problem and I'm going to see if I had any withdrawals. And yes, we did. Don Megafin withdrew $1,100. Okay, so I am going to highlight that number here. That way I know that I've used it. because what happens is we need to make sure that we utilize all of the numbers in your worksheet provided. Okay, we want to make sure that we use them all. So my drawing was $1,100. Okay, so I'm going to do $1,100 here. So now we need to figure out, did my capital go up or did my capital go down? Well, I need to figure out if your capital increased or decreased. So this is what happened. During the month of January, you generated $838 in income. This is how much money the business generated. You, the owner of the business, withdrew $1,100 from the business. You withdrew more than what the business made. So, is your capital going to increase or decrease? Well, because you withdrew more than what you made in income during the period, then your capital is going to decrease. So we have a decrease in capital. Okay? So what I'm going to do here is I'm going to calculate my decrease in capital, and that's going to be your 838 minus your 1,100. So that means that your capital decreased by $262. Okay? You made $838 in income, and you took out of the business $1,100, causing your capital to go down by $262. So now we can calculate our ending capital. Okay? So we have our Don Megafin capital, but now this is as of January the 31st, the end of the month. Okay? So as of the end of the month, okay, I started off with $8,000 in capital. Okay? And I had a decrease of $262. So that means that my capital as of the end of the month is $7,738. Okay. Now that number is very important because that number is going to flow, it's going to flow into your balance sheet. Okay. So if you see here, the information that you're preparing in each of the financial statements will flow onto the next financial statement and the next financial statement. So that number right there needs to be correct because that number is going to be used in your balance sheet. Okay? So your statement of owner's equity is complete. You start off with your beginning capital. You add your net income. You deduct any withdrawals. You identify your increase or decrease in capital. And then you figure out your ending capital for the period. Okay? Now, the last and final financial statement that we're going to be preparing is our balance sheet. Now, read Chapter 6 very carefully because in Chapter 6, your balance sheet changes. Okay? There are some new features introduced in Chapter 6 with how the balance sheet is organized. We are going to be using the report form of the balance sheet for Chapter 6 and going forward, which basically means that the liabilities and the owner's equity section are going to be shown right below the assets. So before our balance sheet, we had our assets on the right-hand side and liabilities and owner's equity on the left-hand side, and then they balance. Well, that is changing in Chapter 6. Now we're going to be using the report form of the balance sheet, which basically lists our assets. Below the assets, we have our liabilities. Below the liabilities, we have our owner's equity. Okay? Sorry, I have a tongue twisting right now. Okay? So, this is what it's known as a classified balance sheet. Also, because we're going to be grouping specific items together. Okay? Our assets are going to be classified as at either current assets and property, plant, and equipment. Okay, so current assets are basically any assets that are going to be consumed or can be converted to cash easily, maybe within a year. Okay, and then we have our property, plant, and equipment. These are any assets that are going to last us a longer period of time other than a year. Okay, This could be your equipment, your building, your land, anything that's going to have, you're going to retain in your books for a longer period than 1 year. Okay? The same thing is going to go for the classification of our liabilities. Okay? We're going to classify our liabilities as either a current liability or a long-term liability. Okay? So usually what did I say here? A current liability is any liability that we are responsible to pay within the next year. This could be your accounts payable, your salaries payable, anything that you're going to pay within the next year. Your long-term liabilities are anything that you're going to pay longer than a year. Like, for example, if you have a mortgage, it's a 20-year mortgage, then that's going to be a longer liability. Usually your notes payable, your mortgage payable, anything of that nature that's longer than a year, that's going to be a long-term liability. Okay? So the key here is current assets. Any assets that are going to be converted into cash or used up within 1 year or the normal operating cycle of the business, or our current liabilities are either due within 1 year of the normal operating cycle of the year. And then we have our long-term liabilities or long-term debt. These are basically your obligations that you are not required to pay within a year. Okay? This is something that you're going to be paying longer term. Okay? Your property, plant, and equipment. These are any long-term assets that are expected to serve your business for many years. So this could be a computer. You buy a computer, it's going to last you 5-6 years. You buy furniture, it's going to last you 10 years. You buy a forklift, a truck, anything of that nature that's going to last you longer than a year. You put it under property, plant, and equipment. Okay? So all of that information is explained in detail in your chapter. Okay? So now let's get on going with our balance sheet. This is the new report form balance sheet that we're going to be preparing. Okay? So I'm going to start off with my assets. Okay? So I'm going to go ahead and I'm going to format this. Okay? So I'm going to start off with my current assets. So remember, we have to classify this between current assets and my property, plant, and equipment. So let me look at my problem here. Okay? So current assets are anything that we're going to use up, consume, or convert to cash within a year. Okay? So we have cash. That's going to be included. Accounts receivable. Usually our accounts receivable is converted to cash within 60 days. Okay? You should be collecting your accounts receivable as soon as possible. The longer you wait to collect your accounts receivable, the higher the probabilities that you're not going to collect it. Okay? So accounts receivable is also a current asset. Supplies is also a current asset. Usually we buy supplies that are going to last us a couple of months, not years. Okay, that's not a wise thing to do. Our prepaid insurance, usually we don't prepay anything longer than a year. Usually most of our prepaids are for a year maximum. Okay? And then we have a delivery equipment. Now, delivery equipment, I can say with confidence that the delivery equipment is going to last me more than a year. Okay? So, from this point forward, the only thing I have here is delivery equipment and accumulated depreciation that basically is tied with your delivery equipment. I have to identify which of these are my current assets. Which of these am I going to convert or use up within a year? Okay? So I say that those are going to be these accounts right here. Okay? And let me do green. Okay? That way we can see the different components. Okay? So my cash, my accounts receivable, my supplies, and my prepaid insurance are all my current assets. So I'm going to copy this information over to my balance sheet. Okay? So under my current assets, I'm going to have cash of $36.73. I'm going to have accounts receivable of $14.50. I'm going to have supplies of $400. And I'm going to have prepaid insurance of $6.70. So these numbers are coming from here, from your balance sheet columns, okay? And I'm stopping there because even though delivery equipment is an asset, it's a longer, it's a, this particular asset is classified under property, plant, and equipment because it's going to last me longer than a year, okay? So this is where I'm bringing in my information over to my balance sheet. So I'm going to add these amounts together, and I'm going to get my total current assets, okay? I'm going to add them up. And my total current assets are $6,193, okay? The next thing I have is property, plant, and equipment. And usually I abbreviate PPE, property, plant, and equipment, okay? And for my property, plant, and equipment, I have my delivery equipment of $3,200. And every time you bring in the asset account, you have to also bring its accumulated depreciation that is tied to it, okay? So I'm going to bring in my $3,200 and my $55 accumulated depreciation, okay? So I'm going to bring those two amounts into my next section of the balance sheet, which is my property, plant, and equipment. Now, $3,200 is a debit, $5,500 is a credit. So make sure when you transfer that information over, you transfer it accordingly, okay? So I'm going to start off with my delivery equipment. Okay, my delivery equipment, I have it for $3,200. Okay, now my equipment has depreciated. I'm going to deduct less my accumulated depreciation. Okay, my accumulated depreciation is $55. Okay, so I'm going to go ahead and I'm going to put that $55. Okay, so now I'm going to I'm going to calculate here my property, plant, and equipment. Let me do an underline here. Okay. So my balance for my property, plant, and equipment is my $3,200 less, which is minus your $55. So your property, plant, and equipment is valued at $3,145. Okay. Now I can calculate my total assets. So to calculate your total assets, you're going to add your total current assets plus your property, plant, and equipment total, and that's going to give you a total of $9,338. Okay. Now, because we are doing the report form, we're going to continue with our liabilities. Okay. So, my liabilities, let's go back to our problem. This is anything that you owe, okay? So I have my accounts payable. So whenever you see or you hear a liability, it usually has the word payable on it. So we have accounts payable and we have wages payable. So we have two liabilities, okay? So I'm gonna highlight these right here, that way we can identify them. And let me pick a color. Let me do that one, okay? And then that way I can see. So these are my liabilities. I have two. I have accounts payable and wages payable, $1,200 and $400, okay? So I've got, remember, we have to classify between current liabilities and long-term liabilities. Now, in this case, we have wages payable, okay? This is any, wages payable is any amount that you owe to your employees. Usually your wages payable are paid out the following month, okay? So that's going to mean it's a current liability, okay? We also have accounts payable. This is any money that you, let's say you bought something on account, some supplies or anything of that nature. You have a line of credit open. Usually you pay your accounts payable within 30 days, 60 days, okay? Usually your accounts payable doesn't sit in your books longer than a year. So both of these accounts are current liabilities, okay? If you had any liabilities that were long-term, for example, anything that was a notes payable, then you would go ahead and you put it as a long-term liability, which is not the case here, okay? So under my balance sheet, I'm going to go ahead and I'm going to put my current liabilities, and I only have 2 liabilities. Okay. So the first liability I have is accounts payable for $1,200, and then we have wages payable of $400. Okay, so now I can figure out my total current liabilities, which is the sum of the $1,200 plus the $400. That's going to give me $1,600. So this is my total liabilities that I have. Okay, I have total current liabilities of $1,600. Okay. The next section I have is my owner's equity section. Okay. I'm going to bring that in. Okay. So I'm going to start off with my capital account. Okay. Your capital account, well, if you look at your balance sheet, I'm sorry, at your worksheet, you've used up all of the numbers in your worksheet. All of the numbers have been used up. Okay. So for your balance sheet, you're going to bring in your capital account. Okay. Don Mega Fin. Capital. Okay. And this number is coming from your statement of owner's equity. Okay. So that $77.38 is going to flow into your balance sheet. Okay. Okay. Now I can calculate my total liabilities and owner's equity. Okay. And this one, since I only have one, I'm going to take it over to my second column. Okay. So my total liabilities, I'm going to go ahead and I'm going to get my total current liabilities, which is $1,600, plus your total capital, which is $77.38. That means that your total liabilities and owner's equity is $93.38. Okay. Now, your total liabilities and owner's equity must equal your total assets. Okay. If it does not equal your total assets, then you made some kind of mistake, and you need to make sure that you fix it before you move any forward with doing anything else. Okay. So your total assets need to equal your total liabilities and equity, which in this case it does, $9,338. Now the most common mistake that I get is students bring in the capital account instead of bringing in the $77.38 from your statement of owner's equity. They bring in the capital account from your worksheet, which is incorrect, and then that will throw you out of balance. So just make sure that when you are bringing in your capital account, you bring it in. You bring it in from the owner's equity statement. Okay. So that is just the most common mistake that students make that causes them not to be in balance. Okay, so just make sure that you are in balance. And then after you are done with this, you are done with your 3 financial statements. Okay, like I said before, your income statement, revenues, and expenses. Okay, your owner's equity, it's your capital plus your net income minus your net loss if you have any, less any withdrawals. You're going to be calculating your either increase or decrease in capital to calculate your ending capital for the period, which then is going to flow into your balance sheet, which basically identifies or reports your assets, your liabilities, and your owner's equity. And then your accounting equation must balance. Your assets must equal your liabilities and owner's equity. Okay. So this is an illustration of problem 6-7A from the end of your chapter. It illustrates how to complete the three main financial statements that we are focused on. So make sure that you do read your chapter in its entirety, that you do attempt your homework problems. If you have any questions, please make sure to send me a Blackboard message or call me during my scheduled office hours, if any. But just make sure that you review the information provided in your textbook, that you listen to this short presentation, that you look at the different resources in your textbook. They have different figures that give you examples so you can utilize for reference. Okay? But if after all that you still have questions, do not hesitate to contact me. I am here to help you. Okay? So that is the end for this short presentation over Chapter 6. See you next time.